Welcome to our video explainer on getting to grips with directors' loan accounts. So what is a director's loan account? Well, essentially it's a method for keeping track of the transactions between a director and their personal or family company. This generally keeps a record of money taken out of a limited company which isn't a salary, a dividend, or a business expense repayment. It also accounts for any money lent to the company by a director or shareholder, which could cover the purchase, for example, on new equipment, a cash flow injection, or other investment. HM Revenue and Customs, or HMRC, must be provided with the director's loan accounts through annual company returns. In your director's loan account, you should record cash withdrawals and repayments you make as a director, personal expenses paid with company money or a company credit card, and interest charged on any loans. When a director takes more money out of the company than they put back in, the loan account can become overdrawn. Money should be paid back by within 9 months of the end of the accounting period to prevent a significant tax bill arising. If you're a shareholder and director and you owe your company more than £10,000, your company must then treat the loan as a benefit in kind, pay over Class 1 national insurance on the balance, or charge interest at HMRC's approved rates. The interest will need to be physically paid back to the company. If interest is not applied to the loan, then the value of the loan will need to be included on the director's self-assessment tax return and will result in extra taxable income being attributed to the director. Where money has been loaned to the business and the director's loan account is in credit, the director can draw on the credit balance at any time without any tax or national insurance implications. Where a company pays interest on the loan, a director needs to declare the interest received on his or her personal tax return and pay tax on that interest. The company would need to also declare any interest paid on quarterly returns to HMRC and deduct tax from the payments made. A director's account may also have a credit balance if dividends or salary payments are credited to the account. This is often the case where a director is protecting a business's cash flow by delaying a dividend payment. Close companies that are privately owned by 5 or fewer shareholders or directors should be aware of the implication of directors' loans. To deter directors or shareholders paying themselves via loans in a tax-efficient manner, there are rules, which triggers a corporation tax charge known as the S455 tax. This is equal to 32.5% of the owed loan. If later repaid, a company can then apply to get this tax back from a loan 9 months from the year end in which the repayment is made. Directors' loans can offer a number of advantages that could reduce your tax liabilities. Considering the complexity of the tax rules surrounding loans and dividends, especially changes to dividend tax and the S455 tax, it's always best to seek individual advice. If you need assistance with directors' loan accounts, please speak to our team, and here are the contact details.